Welcome back to Simple Mind Space, your go-to podcast for mastering your money and your mind. Today, we're diving deep into the current state of the U.S. economy and what it means for your financial future. Now, you might have heard whispers about a potential recession looming on the horizon. The economy is a complex beast, and sometimes it feels like deciphering the financial news requires a PhD. Fear not, because we're here to break it down for you in simple, actionable terms. Recent data has painted an interesting picture. The U.S. economy, much to the surprise of many analysts, actually grew at a faster pace than anticipated in the second quarter. We're talking 3% growth, a significant jump from the 2.8% most economists had predicted. This is positive news, signaling that the economy might not be slowing down as drastically as some feared. But before we breathe a collective sigh of relief, there are other factors at play. The Federal Reserve, the institution tasked with keeping our economy stable, is closely watching these developments. Their main goal is to control inflation, which is like trying to keep a balloon from bursting. Too much air and it pops. The Fed uses interest rates as a tool to manage inflation. When they raise rates, it becomes more expensive to borrow money, which can slow down the economy. Conversely, when they cut rates, borrowing becomes cheaper, potentially stimulating growth. Now, the big question everyone's asking is, will the Fed cut rates in September? Well, the recent GDP numbers might give them pause. Remember, the Fed wants to see slow and steady growth, not an overheating economy. If they cut rates too quickly, they risk reigniting inflation. Another critical piece of the puzzle is the job market. The unemployment rate recently ticked up to 4.3%, a move that often precedes a recession. However, there's a twist. This time, the increase in unemployment isn't necessarily due to massive layoffs, but rather an increase in the number of people entering the workforce. Imagine a scenario where a company has 100 employees and 10 open positions. Suddenly, 20 people start looking for jobs in that field. Even if the company fills all 10 positions, the unemployment rate technically goes up because there are more job seekers than available jobs. This is a simplified example, but it illustrates why the Fed is walking a tightrope. They need to decipher whether this uptick in unemployment is a sign of a weakening economy or simply a reflection of more people actively seeking employment. So what does this mean for you? Well, first and foremost, don't panic. While the future remains uncertain, understanding the forces at play allows you to make informed financial decisions. Here are some key takeaways to remember. Stay informed. Keep your finger on the pulse of economic news, but don't let it consume you. Focus on understanding the trends, not the day-to-day fluctuations. Don't time the market. Trying to predict when the market will rise or fall is a fool's errand. Instead, focus on building a diversified investment portfolio that aligns with your long-term goals. Live within your means. This timeless advice holds true regardless of economic conditions. Create a budget, track your spending, and make saving a priority. Remember, knowledge is power. The more you understand about the economy, the better equipped you'll be to navigate any financial storm. That's it for today's episode. If you found this information valuable, please like, share, and subscribe to Simple Mind Space for more insightful content on mastering your money and your mind. We're here to empower you on your journey to financial freedom.